morning, everyone. Thanks again for you all taking the time out of your busy schedules to participate in this class. Um, as Quandra said, my name is Jason Swan. I work as the Assistant Vice President of Community Banking for Beverly Bank and Trust, which is a subsidiary of Wintrust. What we've been doing here is, starting last week is participating with your organization to kind of provide some insight for small businesses and entrepreneurs around kind of what banks look for in competitive and successful credit applications, and also how banks can more successfully cooperate with that demographic and helping them reach their goals. So my role at the bank is definitely to help facilitate loans for small businesses. I do some work on the deposit side and some work on the treasury management side, but the bulk of my work is in helping businesses obtain financing. And so with that said, we wanted to have a conversation today about the documentation that banks are looking at, and what that documentation means, and then how you structure that documentation, how you read that documentation, and even outside of how that information can be used to obtain or to submit a competitive loan application. It's also a conversation about how you can use these documents to kind of project your own business or solve for different challenges in your day-to-day business activity. I also want to encourage this to be as much of a participatory conversation as possible. Having a dialogue around this stuff is really, at least I found in my experience, that it definitely helps folks to learn. Obviously, we don't want to share too much sensitive information or personal information as it relates to the business. But we do want to be able to have the conversation so that it addresses real life and real time concerns, so that hopefully we can, arrive at potential solutions for that. So with that being said, we'll go ahead and we'll jump into the first of the documents I'd like to peruse. It's going to be the record keeping document, Quandra. And the reason that I kind of wanted to go to this document was I wanted to kind of focus on page 6 of 18. A lot of this document is really self-explanatory. I don't want to spend a lot of time, reading stuff to you that you guys can obviously read on your own. I did want to focus on the reasons for keeping good records. And so that's the detailed tracking. So obviously, as business owners, one of the things that we hear often, again, that'll be page 6. One of the things that we hear often is that business owners know how to work on their business, but not necessarily in their business, or vice versa. So one of the things that good record keeping will allow you to do is to kind of, from a macro level, manage more components of your business. I would always encourage you, as your business grows and as you have the wherewithal, to hire the right people. But depending on where you are in your business cycle, that may or may not be feasible. So managing some of these statements, financial statements, and learning what goes into them is going to be crucial. Next week, we are going to, or the week of the 23rd, I believe, there's going to be a more thorough conversation around accounting. And so I think that we will revisit this document for those that are going to participate at that time, and kind of dive into it a little bit more thoroughly. But paying attention to the fact that strong records allow for successful business planning, keeps you legally compliant, and allows you to successfully prepare your taxes, is kind of the larger overview of why this is important. Diving into the weeds a little bit, kind of in reverse order. So banks are really only in a position to tell the financial health of your company based on your business's most recent tax return, right? Particularly, we pay attention to the sales that you've generated throughout the year, and we pay attention to how you've accounted for your revenue generation. So there's really two different ways that you can account for generating revenues. And again, we'll dive into this a little bit more when we have the tax class. But you account for your revenues in real time. So that's cash-based accounting. And then there's what they call accrual accounting, which is when you account for all of your sales in a given tax year, regardless of whether you've been able to monetize those sales. And so what I mean by that is you may be the kind of company that generates a $30,000 sale, right, based on the kind of work that you do, but you may receive a deposit for that work in February. You may receive an additional deposit for that work in March or April, depending on how much of the work has been completed. And then you may not realize all of that income until, probably July, let's say, depending on the kind of project that it is. So what that means for us is that while your business may very well show that it's generating a certain amount of revenues for the year, how those revenues are invested into your business's day-to-day operations is really the devil in the details that the bank looks for. And so I think that that's a good place to say that it's vitally important that you are segregating your business activities from your personal activities. So that's where, that legal compliance conversation comes in. If there's a thing in finance and in legality known as the corporate veil, which kind of exists as this distinction between your operating business and you, the individual, and any other interests that you have. So one of the things that we always encourage businesses to do is to maintain separate bank accounts for their business activity versus their personal activity and never commingle them. Even if you are paying yourself, it's always important to have the correct paper trails, or in this day and age, the digital trails that'll allow you to show that there was money that was transferred from your business back to the company and vice versa. I've got an example of that. It's an issue that we're working with now. We've got a company where it shows that the owner has invested upwards of $4 million into their business since its origination. It's being carried on the balance sheet as a loan from the shareholder. And that's a concern for us, right? Because we have, if you're looking to borrow money from us, we don't want the company to have so much debt that it's only robbing from Peter to pay Paul, right? And so if you show up as a lender to your company, there can be obligations that would allow any money that we would give you for a specific project to go back to you individually. And so that's challenging in order for us to be able to kind of move forward with this borrower's request. It also works out in terms of, liability. So, if God forbid something ever happened on a job site or at your place of business, and, one of your customers were to take legal action against you, and they were to win, that litigation, if the judge determines that the corporate veil has been pierced, not only are your business's assets subject to liability, but your personal assets could be subject to liability as well. So making sure that, from the very beginning or from wherever you are in your business life, you are proactive about, making a clean break between all of the different entities, right? It's important to remember that once you establish a business entity as an LLC or a corporation or a sole proprietorship or partnership, and you obtain an EIN number, which is an employer identification number for that entity, it becomes a living entity, right? And so it has its own operations. And just like, you would think twice about co-signing on someone for a vehicle without really knowing, who they are and what their histories are, you can apply the same logic and the same understanding to how in litigation and in finance, we're looking at the business as its own entity, as well as the individual guarantor. And, that leads us back up to this idea of planning, right? So what do you want your business to look like? What are your short, interim, long-term goals for the business? We always encourage businesses to obtain a business plan because it allows us to do a couple of things. One, it allows us to kind of see where the business is going. It allows us to see what your management capacity is, how much you've invested into understanding the market, but it also allows us to see what your understanding of real life business numbers are and operational numbers are. So we always have some hesitation whenever we look at someone's projections and they're just blanket round numbers. That's concerning because it means that you haven't spent enough time on the math, right? You haven't spent enough time on the detail of it, which takes us to that last bullet point, essentially, which is that, you want to be able, when you walk in to have a conversation with me about borrowing money, I want to be able to ask you about the information that you've presented to me. And I want you to be able to zero in on things that would be a cause of concern for anybody who's assessing risk as it relates to your business, right? So if you say to me, Jason, I want to go acquire a $500,000 building, I got $100,000 down, and I got a grant from the city of Chicago that's going to help me do the build out, right? So you got everything that you need in order to acquire the building. But what happens is, where is the money going to come from to pay the debt? Because realistically, it's going to take you 3 months to get up and running, right? Or it may take you some time in order to start generating revenues from your business. How do you pay for the employees? Where does that capital come from? And if you've used that whole $100,000 that you'd saved in order to be the equity investment in your business, just because you can acquire the real estate and you can meet the debt service, or you can meet whatever the standards are to acquire the real estate, how do you end up meeting those mortgage payments and meeting the other monthly obligations that you'll have in the business, right? So there's really 3 levels that as an entrepreneur, you need to be prepared to look at your business on. So you obviously want to be prepared to look at it on a day-to-day operation. You want to be prepared to look at it weekly for yourself, and then you want to be able to look at it monthly. As a bank, we look at it monthly and annually. And so when we ask you for your projections, typically we'll look for your first 12 months of projections to be monthly breakdowns. And then we'll look for years 2 and 3, let's say, to be annual, right? So with that being said, I think that I kind of want to leave the record keeping presentation there for now, because I don't want to give too much on this accounting subject and have it take away from the financial management conversation. So if we can switch over to the financial management handout and just kind of scroll down to page 8, I think that'd be great. And then anytime that if you guys have questions or concerns, please feel free to speak up and let me know that we need to take a minute to address a question, or let Quandra know, and I'm sure that she'll create the space for us to do that. So when I'm talking about your projections, I'm talking about basically 3 different financial reports, right? So the first that I'm looking for is a profit and loss statement, which is going to be a statement of how much sales you've generated versus what the expenses are that are associated with you generating those sales, right? So if you'll look at page 8, this kind of represents, a boilerplate budget, operating budget on a monthly basis for a business. And so you'll kind of start building your financial model from here, right? So you'll say, how much does it cost, on a monthly basis for me to operate my business from the day I open the door What is it that I need? So obviously I need a door to open. So that's going to be rent or mortgage, unless I'm doing a home-based business. And then, I'm sure the accountant will get into this, but depending on how much time you're spending on your business in your home, you may be able to include, the cost of your personal space in this budget. You'll need to account for what the monthly utilities are. In a changing environment and in an ever digitized environment, that's becoming more and more of a factor, right? So how much are your internet bills in order for you to be able to do things like attend Zoom meetings, for you to be able to order things offline? As it relates to the telephone and internet, I think those are becoming more and more important for businesses to really, kind of invest in. There was a time, and I may be dating myself here, when that seemed more of an ancillary cost, depending on what the nature of your business is. But, given, the current climate with COVID and the pandemic, and also with people just being more apt to shop online and do more online buying and selling, I think that those are costs that we really are kind of keying in on. Obviously your insurance costs. If you kind of take a look at this, for those of you who have had the opportunity to take a look at a business tax return, you'll see that all of these items would be represented on the business's tax return, because that's basically all it does. All the business tax return does is take whatever your monthly operating budget was and multiply it by 12, and that represents what the operating costs were for your business. So as you are starting to prepare these reports, the first thing that you want to key in on is, what is it going to cost me to make the money that I'm looking to make? And sometimes that can be, a harder question than it seems, just because you may or may not know exactly what it is that you need to get where it is you're trying to go. So that's why we always encourage folks, to sit with a group like Sunshine Enterprises and do some background and research on the industry, so that you can learn what kind of costs to anticipate or expect as it relates to your business. I think a lot of times what happens is, people have an idea about how much a core product is going to cost, but there are ancillary costs associated with, getting that product out into the market that I don't always know that we're spending enough time preparing for. It looks like there's a question there, Quandra. I don't think that they saw the document. Do you see it now, ma'am? Okay, cool. All right. So if we can move down to page 12, that'd be helpful. So what we want to take a look at is a balance sheet. And I want to spend some time on this because we kind of need to explain what a balance sheet really is in order to move the conversation forward. So a balance sheet is a summary of a company's assets, its liabilities, and its underlying equity, right? So the way I break this down is, you create liabilities to generate assets, and then you generate assets to create revenue or cash or owner's equity, right? So, if you look here at how the assets are listed, they're broken down into current assets versus fixed assets, or what they call long-term assets. Current assets are things that can be immediately turned into cash or cash itself. So that's why you see it first. The next thing would be your receivables. So that's money that you get based on agreements or terms that you've established with your customers. The next most liquid thing is your inventory, right? And then finally, it's prepaid expenses, because those represent cash that you don't have to pay. If you pay your rent up front by 4 months, then it's not money that's being drained from your cash. So it represents an asset to you, right? And then you go down and you see there are long-term assets or fixed assets, like your land or your building or machinery or office equipment. And the reason that we call those long-term assets is because you don't expect to convert them to cash as quickly as you would the items that are listed under the current asset section. So that's important, and that distinction is important because liabilities are divided the same way, right? They're divided into current liabilities versus long-term liabilities. So in real time, what that looks like, that says if you come to the bank and you get a line of credit to, for your business, a line of credit is a short-term liability because it's expected that you'll revolve that line and you'll generate the money to repay the balance of that line within a 12-month period, okay? So the way that works in real time is you say, Jason, I need a $100,000 line of credit, and you're a contractor. The reason that you get that $100,000 line of credit from me is because you front fund the cost of paying your guys or your employees, and you front fund the cost of some of, your tools and the machinery. But the idea is that once you've completed that job, you'll get that $100,000 back and then some. So you'll be able to reduce the balance of that liability. And the way it's offset is that you'll see when you take out that $100,000 line of credit, you'll see a liability, a short-term liability of $100,000, but you should also see the cash go up on the asset side under the short-term assets, right? Same way when you go and you get a mortgage for a building. If you'll see under long-term debt, you can have, a mortgage for your business's location for $300,000. But if you go up to the assets, you'll see that the building itself has a value of $300,000 if it's dollar for dollar. So that's why they call it a balance sheet, because whatever happens on one side of it has to have an offsetting entry on the other side of it. So what a balance sheet is a point in time photograph, is the way I like to look at it. It's a photograph of the value of your business at any given time. And obviously the equity is the difference between the total value of your assets minus the total value of your liabilities. So if you were to bring your balance sheet at any point in time to someone, they should be able to look at that document and say, all right, this is what the company is worth, right? So I guess to kind of nail the point home, it's like it's a company that went out of business. Okay, Enron. Enron was a company that had a very healthy balance sheet, let's say on December 31st, 2007, right? Let's say that it was showing that it held so much in cash and that the resulting equity was a certain thing. However, when the stock reports broke the very next day that company was involved in illegal activities and shareholders started pulling all of their investments out of the company and all this debt started piling up, what you would notice is that the owner's equity or the value of that company would have changed overnight, despite whatever their sales are, right? So if a balance sheet is a point in time, what we were looking at on page 8 in those monthly operating expenses are more like a video, right? So all of that ends up lending itself to what goes on your balance sheet, okay? If we can go down to page 15 really quickly, I think that's a good place to start it. That's a good place to continue the conversation. So page 15 represents a cash flow statement, right? So a cash flow statement is essentially a statement of how much cash your business is bringing in on a day-to-day, week-to-week, month-to-month basis. So going back to our conversation earlier, when we were saying that there's different kinds of accounting in terms of accrual versus cash-based accounting, what that really means is that the bank is always interested in whether or not you can pay its loan, right? So what that means is how much cash do you have at the end of the day to service a debt? So the bank uses a metric called the debt service coverage ratio, right? And that debt service coverage ratio essentially is looking at, for every dollar of debt that you've created, how much do you have to service that debt? So the bank's baseline debt service coverage ratio is 1.25 times. So what that means is for every dollar of debt, after all of your expenses have been paid, you need to have $1.25 available to service that debt, okay? So the way that we get at that number is we take a look at how much cash the business is generating according to whatever cycle it's reporting. So that's why you hear about a lot of businesses get in trouble with factoring companies as far as trying to finance their receivables. So what they'll do is, and unfortunately, you'll see it with a lot of businesses that do business with the state of Illinois or with municipalities. So somebody will have a relationship with the state, and the state will say, all right, we owe you $15,000, $20,000. But unfortunately, when you work with the state, it can take them 30, 60, 90 days to pay out. So you're still generating those monthly expenses to facilitate and operate your business, but that cash isn't coming in. So you being able to understand that cash flow projection is intended to help you budget how you'll be able to make those ends meet, especially given who your vendors are. Or it's a conversation about, should you be diversifying the kind of customers that you engage, right? So you know the state's going to pay, it's just a matter of when, right? So you know, hopefully this allows us to kind of revisit the conversation about how you can use these statements to plan. And then if you scroll down a little bit to the next page, you'll see there's a conversation about a profit and loss statement, right? So that profit and loss statement really is supposed to be a combination of the two, right? So if it's accrual-based accounting or non-accrual-based accounting, you want to be able to account for what your business has done in terms of generating revenue that month, right? And so ultimately, what you'll need to do is you'll need to make accounting decisions about how you want to recognize your revenue for the sake of helping you plan your business activity. Does that make sense? Okay, I think this is probably a good place to stop and take a break and see if folks have questions about any of the stuff that we've presented.
So are there any questions regarding the cash flow statement, the balance sheet? Is profit and loss very similar to the income statement?
They are the exact same thing.
So we have the profit and loss, income statement, record keeping, how the banks look at your assets versus your cash flow versus your balance sheet. What's important when you go into the bank asking for money to finance a property or provide you with money for your receivables or for your or a loan in general. Okay. Well, I think you're doing an excellent job. There aren't any questions.
Okay, all right. So I think the way the bank looks at this stuff is really important. So depending on the kind of credit that you are applying for, different things are going to be relevant. So I think the best way for me to have the conversation is to talk about Wintrust-based products, but that doesn't mean that they may not apply to other financial institutions that you work with. So I'm sorry, was there a question? I think I missed it. I was talking.
Yes, there's a question about QuickBooks. What is your recommendation on your thoughts on QuickBooks?
So I think it depends on the size of your business. QuickBooks, I think, is a paid service, but there are other services that are that are free that you can use. So if you're kind of just starting out and you're doing things independently, I would encourage you to kind of invest in some of those free services, because you don't want to add unnecessary operating costs to your brand new business. And it allows you the opportunity to learn things about inputting that information on your own, right? So experience is the best teacher. And QuickBooks, once you set it up, it kind of goes on autopilot, right? So that's why I definitely think it's worth what the cost is. But if you're just starting out and startup funds are limited, you can definitely save on accounting software by doing the research on which ones are free.
Okay, so then that leads me to ask the question, the difference between doing QuickBooks or hiring someone to do your record keeping. Do you prefer one over the other?
So I think all businesses should definitely have an accountant. They should all have an attorney, and they should all have like a couple of bankers that they work with. Having said that, I think that it's important, especially for newer businesses, to kind of learn, the details of some of this stuff. So I think that there should be a combination of the two efforts. And I saw the question about getting the free software recommendation out. I'll do some research and make sure that as a bank representative that those are safe for me to recommend, and then I'll send them to Quandra so she can distribute them via email.
Mm-hmm. Great. Yeah, well, thank you. Well, it looks like there may be another question.
No, she was just saying.
That's the same one. Okay.
Yeah.
All right.
Okay. So, kind of keeping in line with this, like the way the banks look at this stuff. So, typically, if you're looking for less than $150,000 for a line of credit or something like that, you'll really just need to provide your most recent business tax return and your most recent personal tax return. And you got to make sure that those tie out to each other, right? So what it'll show is that there'll be net income from the business. We should be able to see that net income flowing over to your personal tax return. And I think what happens is, especially in minority entrepreneurial communities, is that we've been conditioned to kind of hide money, right? Or to not necessarily disclose everything for our own benefit. And what I'll say is that while I understand that, and that gets us to a certain place, it can also be harmful when we try to, work with traditional financial institutions. And sometimes banks aren't as sensitive to the historical record as we'd like them to be in terms of moving forward. So I've had it where we've had to have some business owners go get their tax returns amended to more accurately reflect what it is they have going on, because they haven't necessarily disclosed everything in their tax history for one reason or the other. So that's important, right? And a lot of times when you're looking at...
I have a question. This is Quandra.
Yes, ma'am.
This is a good time to jump in?
Yeah, absolutely. You're breaking up a little bit.
They may... Oh, okay. Is this better?
It is. Go ahead.
Okay. If it's not, let me know, and maybe I'll just wait until the end. We have a lot of our businesses are startups. And so can you explain how many years can a business be in, can a person come like the next day after they open up their doors, get this rated and get a loan? Is it after a year, 2 years, 3 years? What is there a set?
Sure. No, I hear you for sure. So it really depends on how much you're looking for and what you're using the money for. So the SBA has a startup program that will give businesses with less than 6 months of operating history potentially up to $350,000 if the debt can be supported, right? But the SBA has to do that through a financial institution who can get comfortable with the request. So what that ends up being is that you need to have the wherewithal to support the debt at the time of the application. So the bank is really not going to lend to your projections, especially as a startup business. So one of the things that I preach to startup businesses is that if you have a separate source of income, don't quit it just because you got your business off the ground. And especially if you're looking to borrow money from a lender, because the bank is only going to look at the borrower's ability to repay the debt in real time to meet that 1.25 times debt service coverage. Remember, you always provide a personal guarantee for your loan. So the bank 9 times out of 10 is going to look at you globally. The largest deal I've done for Wintrust, I was a part of a $30 million transaction, and we still had to take a look at the personal wherewithal of the guarantor to show up in the event that something fell off of the rails, right? So being able to show that you have the strength personally to generate that revenue is important, which is why if you take a look at the tax return, you know, the first line of expenses on your tax returns are compensation to officers, right? So even the federal government expects you as a small business owner to pay yourself first. Wages and salaries are on a separate line. That's what you pay your employees. And if you are someone who uses subs, that expense is buried in the cost of goods sold, right? But you always need to you know, kind of account for what your revenues are, or the revenues that you're getting out of the business, even after you've established it, so that somebody can see that, you know, the business has backup. I would also say that, you know, obviously, so the bank's position is to mitigate risk, right? So the bank is always worried about losing its money. And the reason for that is it's really logical. So the cost associated with making a $100,000 loan is the same as with making $1 million loan, is the same with making a $10,000 loan. However, if the bank loses money on a $100,000 loan, somebody would have to do $3 million in loans to make up for that loss, right? So the bank's margin of revenue is very thin in its own business model. Banks make money based on the difference between the interest rate that they charge on loans and the interest rate that they pay out on deposits, right? So let's say you came and you applied for a secured loan, and I would put that in the CD. Legally, I would only be able, or at least according to what my bank's doing, I would only be able to charge you 2% on that loan, right? Because that's a reasonable revenue rate that's acceptable for us, right? So with that being the case, you know, you need to be able to show the bank that you are as low of a risk as you possibly can in terms of submitting the application. I saw a question come up, but I'm sorry, can you repeat that question?
Yeah,
ma'am?
we have a question. Is it Felicia?
I think that's who it
You
was.
want to unmute yourself? Yeah, let me see if I can unmute her. Well, it's here, so let me just read it. She's asking if you are ready for a large loan but want to establish a relationship with the bank, would a secure line of credit for the business be a way to start, especially if you are improving your personal credit history? For example, if I have $1,000 and the bank gives $1,000 against it, and when I repay it, it may establish a higher line of credit versus coming in as a co-applicant.
So I think I understand the question. So the first part of it is, obviously, establishing a relationship with a bank is always the best way. Establishing a low risk relationship with the bank is always the best way to introduce yourself, especially if you want to do new business. But you don't necessarily have to borrow against it just to show that you'll repay it. You know, you can go in and you can establish a deposit account and start having a conversation with your lender about what your goals are and where you're trying to go with the business. And I think I want to qualify, when you say large loan, how much were you talking about?
Let me see if I got her. Oops, I guess not.
Oh, I think
Felicia,
I
did you want to?
Did I do it? Did I unmute? Can you hear me?
Yeah, you're talking.
Oh, okay.
Yes.
All right. I'm working at school, so I'm gonna make it quick, but I have to go back to work at 12. I didn't mean to say a large loan. I was trying to say if you wanted to establish a relationship, like you said, low risk, relationship with the banker, but your business isn't large. because I don't have a large business. I'm not at the point of um, borrowing like that, but I was thinking it would be, like you said earlier, better to have some kind of familiarity with bankers or people in banking prior to going in for something like that. And I was wondering, was a secured line of credit or something like that, because of if your own personal history, credit history is something you're working on, would something like that be a way to do it? But you mentioned the deposit accounts and things like that, and I hadn't considered stuff like that.
Yeah, no, you're definitely on the right track. So, one of the things that, we're working on as a financial institution and hopefully as an industry is to have these conversations and develop these relationships at least 12 months before you're ready to borrow. Like, even though we're doing, this class now and you have the opportunity, to ask questions, sitting one-on-one with somebody like me or somebody at the bank and having detailed conversations about what your goals are is the best way to ensure a successful outcome, right? So if you come to the bank and you say, all right, Jason, I'm about 4 months away from getting my personal credit score where I want to be. I'm trying to take a look at, potentially identifying a location, and I want to hire some employees. Here's what my situation is, right? So my conversation with you is, all right, how long has the business been established? What do the year-to-date profit and loss statements say? What are the projections for the business? So the bank really wants to talk to you after some sort of proof assault, right? Like 6 to 12 months of operations is really when the bank is like, all right, this person is kind of moving off of the ground. One of the things that we're confronted with, in Black neighborhoods, throughout the city of Chicago, is that, what they teach you is that the bank shouldn't be the first place that you go to borrow money, right? So the first place that you should go to borrow money would be from yourself. Then the second place is family and friends. And then the third place is the bank. Well, based on, what we know is the reality in our neighborhoods is that we don't always have those options, right? So what we need to be able to do is kind of frame ourselves based on our existing income, right? One of the things that we have that we don't identify because of the way we deal with our tax reporting is liquidity, right? So you'd be surprised how many entrepreneurs I run into that are cash strong, but when you look at their tax returns or when you look at their personal credit history, it doesn't look like they're as strong and they're as healthy as they are. The issue is that it's not that we can't get them to the place where they can lend, is that by the time they get to us, the opportunity that they're trying to take advantage of is 30 days away, 2 months away, and it'll take 6 to 7 months to get them to look the way on paper that we need them to in order for the bank to get comfortable with financing a transaction, right? So I say all that to say, the earlier you are in your business cycle, the better it is for you to start having a conversation with a banker about what your goals are so that you guys can cooperate on a plan. And then once you've kind of established that, have that conversation with your accountant and your attorney so that everybody's on the same page, right? So that the LLC is established properly and that everybody who's supposed to have an ownership interest does. You have the conversation with your accountant so they're helping you establish a framework or a template for what your monthly. I'm sorry, I muted out there, didn't I? But yeah, you need to be.
No, we can hear you.
Okay. So, you just really want to establish, these baselines early as you can so that your business has been alive for so long. And that way you can have the conversation with the banker soon enough that, they can kind of prepare you for what's real. Like a typical loan application, if all the ducks are in a row, takes 30 to 45 days in the commercial world, right? If you're talking about something, over $150,000. So, those 30 to 45 days are just for me to do my job. That's for me to pull my appraisal, for me to do my underwriting, for me to get an analyst to take a look at it, for me to present it to a loan committee and all of that stuff. That's not time for you to submit an application and then go back and get the tax returns the way I need them to look, and then, you know, go hurry up and open a bank account and put cash in it so I can see that there's cash for the down payment, right? So all of that stuff needs to happen first. And then, you know, we will probably be in a position to see higher rates of approval for some of these requests.
So we have another question about having a relationship with a bank for over 25 years, banking with another one for 3. This person wants to know, how can they go about getting a bank loan? I think you kind of touched on that a little bit, but
sure, no, I can address that. So what you want to do is, so who is your banker, right? Who is the person that is managing your accounts? If you need to transfer money, who is the person that you call, right? And then you call that individual and you say, you know, so these are what my goals are. I want to schedule an appointment. How can the bank help me, right? And then don't let them throw an application in your face. You know, bankers, just like anybody else, are measured according to their productivity. And just like any other industry, you have folks that are good at it and folks that are differently abled with it, right? But the banker's goal should be to leave you in a better financial position than when they met you. So when you go have that conversation, you need to be open to all the different ways the conversation could go, right? So potentially, you know, you sit with a good banker and they say, you know, I technically could approve you for this loan, but if I give you this loan, all it's going to do is create additional debt for you that you don't necessarily need right now, right? So those are kind of, you know, those are the kind of conversations and relationships that you want to establish, so that you're not just working with somebody who's trying to meet a number for an annual quota. We still there?
yes, thank you.
Did that answer the question? Okay, cool. Okay. So, you know, the last thing that I kind of think that I want to have a conversation about as it relates to this is, you know, a lot of customers, or a lot of people we talk to, you know, have these conversations around collateral. And I think that it's important to kind of debunk some myths. The only collateral that has value in my world is real estate and cash, right? So I'm not interested in you saying that, you know, I've got jewelry, or I've got, you know, vehicles, or I've got machines. Now, if you borrow money from me to buy a piece of machinery or equipment, I'm going to put a lien on that asset in exchange for the money. But I can't have you pledge that kind of asset and in turn look to borrow funds against it. The only thing that I can do that with is real estate. And in that case, it's got to be more than 6 units, or it's got to be titled in the name of an operating entity. And it gets a little bit more convoluted. Obviously, you know, the bank will lend you up to 90% of any dollar amount in cash that you secure a credit facility with. But the reason I bring that up is because it relates back to the balance sheet when we were talking about the different assets and liabilities that we'll have to outline in that document. That value is strictly for you to be able to show at any given time the company could potentially yield this dollar amount after all of its debts have been satisfied, right? So that's basically a tangible net worth. And you'll use that more in terms of your succession planning if you ever wanted to sell the business itself, okay? You say you want to buy a building because of what, Ms. Ford? You want to buy a building with a storefront. I'll also tell you this. The SBA will do that kind of deal. They'll do that kind of real estate loan. but you have to make sure that in order for the SBA to do it, that at least 51% of the entire building is commercial. They can't touch it if it's 50-50 or if it's 60-40 residential. It's got to be at least 51% commercial. The other 49% can be residential. Okay?
So does Wintrust or Beverly Bank, do you all have a relationship with the SBA? Do you do SBA loans?
Yeah.
Okay.
So I can do, internally, I can do an SBA loan up to 350.
Mhm.
Otherwise, I have to partner with a third party group like Summer Corps to do
Mhm.
to do larger loans. So the product that I can do in-house with our own underwriting is called an SBA Express loan. The products, the 7A products and 504 products are products that we have to go outside for, but it's because it's from the SBA. All the SBA really does is they guarantee a portion of the debt, right? So for those larger loans over the 350, essentially the SBA will make the initial loan, and then the SBA will come in behind us and pay that portion of the loan off and collect their portion from you. For the smaller loans up to the 350, we make the entire loan. The SBA just guarantees 50% of it, but you still have to pay for the full 350, if that makes sense.
It does.
Okay. So we're right around 12 o'clock. I know that one of us had to get back to work at noon. Unless there are other questions, I don't really have much more within the lesson plan. Again, a lot of that information is self-explanatory, but if you start getting to a section where you need some help, please feel free to reach out. And I know that Quandra has our contact information, and she can distribute that information as needed.